The market's going higher. Data and decisions will determine where stocks head over the next week or two. We'll get negative on negative gearing changes, and we'll do a Switzer survey of our subscribers about what they're thinking about investing right now. I'm Peter Switzer, and I'm mad about money. We've got 8 minutes and we'll ring the bell after every 2 minutes for a new topic. Where's Marty and Paul? I don't know. And it makes me even madder about money. Let's get going on markets going higher. And so what we've seen is a run of economic data, which I think is either better than expected or else record highs. There's been one exception over the last week, and that was the investment data that came out last week. Bit of a disappointment in terms of the plans of where investment is heading. December quarter was actually pretty good, it actually rose, but we've got this mining boom problem still hurting investment. But one of the most interesting things that got me mad last week is that a lot of sectors that we are looking at now and are doing well, like tourism, hospitality, all those sorts of stuff, and education, they actually aren't counted in these figures. So I'm not sure whether I trust those particular numbers. Now, overnight, Wall Street, Dow Jones, up 348 points. Now, when I first saw this, I started writing my article for Switzer Daily today, and I said, is this another example of market craziness? And I thought, well, how can we trust it? Usually when there's bad news, the market goes up. So what drove the market overnight? It looks like it was good news. Manufacturing came in better than expected. We saw that oil prices went higher. And also they were quite positive about the Chinese cutting their reserve requirement ratio, which actually means that banks can lend more, which is a good reason to want to buy stocks. And also there's an expectation that maybe the ECB and maybe the Fed will do something nice next week. So the bottom line is good news has actually driven the stock market up. And one really interesting point, 348 points is a nice rise, nearly 2% on the Dow Jones. But what's really nice is that energy stocks did well and banks did well. Banks have been beaten up over the last nearly year, really, but over the last 2 or 3 months, particularly locally, we've seen our banks being clobbered. Now, oil prices up, banks going up, a very good sign. So if oil can keep sneaking up, the banks, I think, are going to be a little bit more protected from falling oil prices, and that's a good sign. That's the bell, I got to change. Now, the next important topic to talk about is data and decisions going forward. So the big data point going forward is going to be Friday US time, and that is the jobs report. They're expecting about 198,000 jobs to be created in the month of February. Now, that's a pretty good number. At the moment, there's a lot of recession talk around. I think they're totally wrong talking US recession. Part of the reason is that unemployment has kept on coming down and the job creation has been averaging around 200,000 a month. So why are they talking recession in the USA? I think probably the overnight rise on the Dow Jones is probably a bit of an expectation or admission that maybe they've gone too far with this recession talk. And what is also really interesting overnight, the money market is now betting a 60% chance of an interest rate rise in December. Only a day or so ago, it was a 30% chance. Now, what's really interesting about this is it's sort of saying, oh, the US economy might be better than we expect, therefore interest rates can rise, but it hasn't spooked the stock market. This is what I would call rational economic and market behaviour. We've seen craziness in recent times where bad news has actually driven the market up rather than good news. Now, what's also important next week is the Federal Reserve in their FOMC meeting will make a decision on interest rates. They probably won't. I can't see them raising interest rates, but they'll probably make some comments that could either help or hinder the market. And then we've got the European Central Bank, Mario Draghi, bound to say something, and I think more importantly, do something that could really help the stock market. Why do I say that? Well, European economic indicators overnight weren't as strong. He made reference to it, not as strong as he would like, and he therefore hinted pretty strongly that when the ECB meets next week, they'll come up with something. Also next week, we're going to see ultimately, possibly, a decision between OPEC and non-OPEC countries. Now, that worries me even relying on these guys, but if they come up with an oil production freeze agreement, it will help oil prices, it will help financial institutions and their share prices, and it should help the stock market as well. Because Marty and Paul aren't here, I'm going to frig with the format of Mad About Money, and I'm going to drag Christine Sinan, who works with us, to talk about the negative gearing changes. Welcome, Christine, to Mad About Money.
Thank you, Peter. Lovely to be here.
Yeah, it was good to have you here. Now, look, I've had some opinions about negative gearing, but you're going to look at what our experts are saying about this negative gearing changes. What have you found?
Yes, well, Peter, Margaret Lomas, our Switzer Daily expert.
And she is an expert.
Yeah, provided a really good, compelling argument yesterday. And it was an article that actually drew a lot of responses from our readers. So it's obviously a very emotional issue. But Margaret, who did premise that she did have a bit of self-interest, being a property investor, but she did actually raise the issue that with tax concessions available with negative gearing, it allows ordinary Australians to access the property market and create real wealth for themselves. So scaling back these changes will have a definite impact. So that was definitely a solid argument to make.
Because a lot of people argue that, you know, people around $80,000 worth of income are buying negative gearing property, but then the critics say, oh well, you know, those people are actually earning more, but by getting their losses in, it brings them down to 80,000. Did Margaret address that issue?
Not specifically that issue. She was just generally saying that those sorts of changes will impact middle Australia, and it's not really about the high-end investor or the high-income earners. And there was probably other measures that could look to address housing affordability, including maybe expanding the first home saving initiative rather than...
But also, the interesting thing about all of this is that, you know, the impact on a market when you change something, it can lead to really, you know, consequences you just don't expect.
That's right. Well, Margaret did touch on the unintended consequences, and any tax changes that will impact the prices of houses will obviously have a long-term impact. And Paul Ricard, your esteemed colleague,
Paul?
Yes, he's definitely. He'll be touching on this issue in tomorrow's article on Switzer Daily, as well as looking at the cuts to the capital gains.
Yeah, because that's what he's really mad about.
Yeah, he says that's going to be the real issue to look at.
Yeah, and a lot of people will be stung. What I think a lot of people are also forgetting, particularly the Labor Party who've put this forward, is a lot of Australians hate shares, and an investment property is a good alternative option for them. And so this is a real kick in the pants for a lot of, I think, Labor voters as well.
Yes, well, I mean, mea culpa, I'm a benefit of negative gearing myself. So property is an investment that really resonates with us.
You know, it's funny, I read an article, well, we're out of time. Thanks very much, Christine, for an objective look at negative gearing.
Thank you, Peter.
And continuing with my frigging of the format for Mad About Money, I'm going to drag Tom Hickey in, who works with us, to find out what our subscribers are saying about their investment attitudes right now to the stock market in these crazy, mad, weird times. Welcome, Tom Hickey, to Mad About Money.
Thank you, Peter.
All right, now just explain to our viewers what you do in relation to the Switzer business.
Well, I manage the Switzer Super Report, so I speak with subscribers every day about what they're looking for when they subscribe to our report and what their sort of views are on the market.
So what I'm looking for is a back of an envelope survey. And
I can give you that.
Yeah, okay. So what is the overall feeling about what's going on in the market right now?
I think basically subscribers are a bit pissed off to see their portfolios.
Maybe I would use the word frustrated, Tom, but still, I get your sentiment. Okay. This is Mad About Money. You can be naughty.
Good.
Go on.
Okay, good. Well, people are peeved, I should say, about seeing their portfolios, diminish in value over the past 12 months or so. But a lot of positivity is all well and good, but when they can see, their stocks going backwards, there's only so much positivity can really do.
Yeah. Do people ever make the view that, okay, I'm unhappy about the short-term developments, but I'm a long-term investor, and apart from my BHP shares, dividends are looking pretty good. In fact, dividends have actually gone up for about a big chunk of the S&P 200.
Yeah, absolutely. That's a point I wanted to make. A lot of subscribers are annoyed on one hand, but at the same time, I mean, they're all intelligent people. They're all investors. They realise that this is normal stock market behaviour. Some days will go up, some days will go down. Some years will go up, some years will go down. But if you're investing in the right group of companies, I mean, particularly in light, as you said, of earnings season, it was a solid earnings season. Dividends are strong still in Australia. BHP was a disappointment, but overall dividends are still strong. If you're invested in the right group of companies with a long-term view, over the long term it'll pay off. So.
Is your job easier when the market's going up or when it's going down? When do people look for advice in a report like the Switzer Super Report?
Well, normally it's been sort of an inverse relationship. You'd think that when the market's going down, people would need this kind of information.
Yeah.
But normally in a bull market, these kind of we get a lot more subscribers.
Yeah.
So it's kind of converse to what logic would suggest.
Yeah, but the irony is, as Warren Buffett said, that when the market's down, that's the best time to buy.
Absolutely.
And that's probably the best time to be looking for good quality companies that have been beaten up unfairly, like I think our banks.
I know, but I mean, people are scared. Sometimes when people see the market's going badly, they just want to bury their head in the sand and look the other way. But we have had a lot of subscribers coming on board over the past couple of months, trying to get more information because it's a good time to be sort of looking at that.
Yeah, okay. All right, so let's hope that it all pays off, Tom. Now, also before I get rid of you, there's an investor day both in Sydney and Melbourne coming up. Tell our viewers about that.
Right, well, on 16th and 17th of March in Sydney and Melbourne, we're running the Switzer Investor Strategy Day.
Yep.
So it'll be a full day session. We're looking at basically the two main goals or sort of principles of investing: how to get income and how to get growth.
Yeah. So where do we go for income according to this conference?
According to our position is that Australia for income and the rest of the world for growth. Australia's obviously got, as I was saying, good dividend paying companies, whereas we see higher capital growth prospects overseas. We've got obviously you'll be speaking there, presenting. We've got Paul Rickard coming along, Charlie Aiken from Aiken Investment Management, George Babouris. So it'll be a full day session. Subscribers can ask questions to the panel, and it'll be a really good sort of insight into their investment strategy.
Okay, so where do they go? What's the website they go to?
Head to switzer.com.au. Yeah. There's a link on the side there to register for that one. It's in a fortnight, so time's running out to subscribe.
But there are a few seats left.
There are a few seats left, yes.
Okay, great stuff. Thanks, Tom.
No worries.
So that's it. I'm Peter Switzer, he's Tom Hickey, and we're both mad about money.